Fundamentals of finance involve managing money, assets, and liabilities to maximize value over time, focusing on key principles like risk-return trade-offs, the time value of money, and cash flow analysis. Core components include understanding financial markets, corporate finance, investment financing decisions, and valuation methods of stocks and bonds. Key elements of finance fundamentals: time value of money, TVM, risk and return, financial statements analysis, capital markets and instruments, corporate finance and financial management, and valuation. Time value of money. The time value of money, TVM, is a foundational finance principle stating that money available today is worth more than the same amount in the future due to its earning capacity, inflation, and risk. It asserts that money invested today grows via compound interest, making immediate cash preferable to future receipt. Key concepts and components. 1. Present value, PV, the current worth of each sum of money or stream of cash flows discounted at a specific rate. 2. Future value, FV, the amount an investment will grow to over a specific period at a given interest rate. 3. Opportunity cost, the potential return lost by not investing money immediately. 4. Inflation, the reduction in purchasing power over time, meaning future money buys less. 5. Risk and uncertainty, the chance that promised future cash flows may never be received. Risk and return. Risk and return are fundamental, directly related concepts where higher potential returns are associated with higher, more volatile risks. The possibility of losing money. Investors expect compensation for taking higher risks, with common metrics including a standard deviation for volatility and formulas to calculate potential gains. Lower risk investments offer lower potential returns, while diversification can help balance this trade-off. Financial statements analysis evaluates a company's financial health, performance, and future prospects by examining its income statement, balance sheet, and cash flow statement. It uses techniques like ratio analysis, horizontal trend analysis, and vertical analysis to assess profitability, liquidity, solvency, and efficiency. Stakeholders use these insights to make informed decisions regarding investments, credit, and management strategies. Key components of financial statements. 1. Balance sheet. Balance sheet provides a snapshot of the assets, liabilities, and shareholders' equity at a specific point in time. 2. Income statement. Income statement reports revenues, expenses, and profitability over a specific period. 3. Cash flow statement. Cash flow statement details the cash generated and used in operating, investing, and financing activities. And finally, notes to financial statements. These notes include significant accounting policies and details. Key techniques for analysis. 1. Ratio analysis. Ratio analysis evaluates liquidity, for example, current ratio, profitability, for example, net profit margin, leverage, for example, debt to equity, and efficiency, for example, inventory turnover. 2. Horizontal analysis. Horizontal analysis compares financial data over multiple periods to identify trends. 3. Vertical analysis. Vertical analysis analyzes each line item as a percentage of a base figure, for example, revenue, to understand the structure of the financial statements. Capital markets are vital financial venues where long-term debt and equity securities with maturities exceeding 1 year are issued and traded to raise funds for companies and governments. Key instruments include stocks, equity, bonds, debt, and derivatives, which facilitate capital allocation, investment growth, and risk management. These markets operate through primary issuance and secondary trading exchanges. Key components and functions. Capital market structure comprised of the primary market, new securities issuance, and secondary market, trading of existing securities. Purpose. Purpose is to connect suppliers of capital, investors, households, with users of capital, corporations, governments, for long-term projects. Role. Role enables economic growth, resource allocation, and price discovery. Major capital market instruments. 1. Equity instruments. Stocks, shares. Represent ownership in a company includes common stock and preferred stock. Fixed dividends. 2. Debt instruments. Debt instruments such as bonds or debentures represent a loan to an issuer in exchange for interest payments and principal payment at maturity. 3. Derivatives. Derivatives are financial contracts such as options, futures, and swaps, which derive value from an underlying asset, for example, interest rates, currencies, stocks. 4. Investment funds. Investment funds are pooled investments including mutual funds and ETFs. Valuation in finance is an analytical process of determining the current worth of an asset, project, or company, primarily based on its forecasted future cash flows, risk profile, and market comparisons. It bridges the gap between market price and intrinsic value for investments, mergers, and strategic decisions. Key methods include discounted cash flow, DCF, intrinsic, comparable company analysis, relative, and precedent transactions. Key concepts in valuation. 1. Intrinsic value. Intrinsic value is the true value of an asset based on its fundamentals, rather than its current market price. 2. Purpose. Used for acquisition, IPOs, capital budgeting, shareholder disputes, and portfolio management. 3. Subjectivity. Valuation is both science and art. It requires assumptions about the future, meaning different analysts may arrive at different values.